Good morning, ladies and gentlemen. My name is Untitled Jonas, and I want to welcome you to Outcome Matters for 2020. Not only is it our first for this year, but it's our first digital Outcome Matters. We're indeed living in extraordinary times. And it's in times like these that we solidify our partnership with you. Although the format may be new, we remain dedicated to share captivating content with you to help your clients navigate through what will no doubt be a pivoting moment in history. The past month has been incredibly volatile for markets, both locally and globally. As we prepared for the year 2020, few would have predicted a pandemic superseding the South African sovereign rating downgrade to junk. The world looks and feels different, and we have different concerns compared to a few months ago. It's natural to feel anxious and unsure, witnessing unprecedented stock market and commodity figures and declining investment values. However, today we present our investment experts to you and allow them to explain why they see opportunity amid the chaos, why they recommend not touching your face and not touching your investments. Now, I've put on my Sunday best for you this morning, and I thought it is equally important to feel comfortable as well. So I want to show everybody and invite you all to not only look as professional as you can, but to feel as comfortable as possible in your offices, in your lounges, in your dining rooms, in your studies. But enough of that. Our first speaker needs no introduction. She, incidentally, is a little bit of a fashion guru as well. I'm pretty sure she's going to appreciate my ensemble more than most. Please welcome our fearless Deputy CEO, Jeanette Marais. Jeanette, over to you.
Thank you, Andile. And I have to agree with you that we indeed are in truly difficult times. Good morning, everyone, and thank you so much for joining us today. For those of you that attended our Global Matters conference, you would have heard us say that these kinds of events in the financial markets have happened in the past, they will happen again in future, but we do know one thing, and that is that markets will recover as they've always done in the past. Given the sequence of events right now, you could say that you should never let a good crisis go to waste. And to be honest, that is one of my life philosophies. But I have a similar sentiment towards a good sale. So funny, isn't it, that the words Black Monday stirs emotions of fear and panic, yet we associate Black Friday far more with the opportunity to pick up a bargain. When a sale takes place, the reduced price of the clothing item or the appliance doesn't change the value or the quality of the item. A similar perspective can be applied to the market fluctuations we witnessed over the past 3 months. The decline in the prices of the companies or the assets had little to do with the value or the quality of the assets, but rather all driven by market sentiment. Always remember that in times of market decline, we find the best buying opportunities. Volatility is not the risk, but overpaying for assets is taking the risk. Now, without giving away my age, I have seen a few crises in this market. And there is one truth that I've come to realize. Markets go through its cycles. But after each sharp fall, we've always seen a recovery. You just don't know when that is going to come. So I want you to consider that perhaps we require these market anomalies in order to create long-term wealth for our clients, but with one caveat, and that is that our clients remain calm and that we help to keep them invested. In 2008, we saw a decimation of equity markets during the global financial crisis. Investors all over the world destroyed value by either fully disinvesting or by rebalancing to cash. They then tried to time their market entry back into equities, and as we all witnessed, they missed that perfect time. They still made money, but by staying invested and orientated around and focused on their goals, they could have achieved so much more. These statistics show that right now, we appear to be making the same behavioral choices, driven by fear and panic, and switching to cash in the second half of March 2020. The problem with switching to cash, on top of the risk of selling low, is that you miss the recovery and you lock in your losses. Further to this, and as I've mentioned, timing the market is virtually impossible, and you end up not being in the market once it turns, and so you negatively impact your returns. You may have seen in one of our recent communications, we demonstrated the performance of the local equity market over a 20-year period and the impact of missing the recovery days and how this impacts the overall performance. We cannot time the market. We need to remain invested. We believe this is where our investment philosophy of outcome-based investing has no better value than when shared and coupled with your advice process. I hope you walk away today with a new perspective to help your clients navigate what is actually just another crisis. It is going to be difficult in the short term, but together we're all responsible for the rebuilding of the economy, and our trusted relationship with you and yours with your client is an important piece of this puzzle. In closing, we believe avoiding emotional decisions and sticking to a long-term investment strategy will ultimately get you and your client to your investment goals. So together with you and our investment team, I want to say, we can do this. Thank you.
Thank you, Jeanette. Insightful as always and very, very interesting. Next up, ladies and gentlemen, I am going to introduce the head of retail portfolio solutions from Momentum Investments. His name is Jaco Diaga.
Hi, Andile. Yes, thank you very much for that introduction. It's, of course, very good to see you again. Of course, this time around, it is a little bit different. We don't have the luxury of spending time in a room together, but I guess a virtual room at this point in time is just as good, if not better.
Jaco, at the start of the calendar year, markets are looking forward to a relatively strong year, especially from growth assets. Now, considering the relatively lackluster performance experienced over the last few years, what's happened since is the complete opposite.
From a portfolio management perspective, it's really a case of looking at both the valuation aspect together with the risk aspect thereof. At the same time, looking at domestic cash, for example, we know that SA cash still delivered a very attractive real yield if we look at what cash rates were relative to inflation. So all in all, those things actually played out or culminated into a position where we felt that from a portfolio management perspective, we were happy to maintain a more neutral weighting between aggressive and defensive asset classes, supported by valuations, but also taking into consideration some of the risk aspects. So within those growth and defensive asset classes, then there you can actually express yourself a little bit differently from a tactical perspective. And it's exactly there where we felt that an overweight allocation to domestic equities served the portfolios better than an overweight to property, for example, just given some of the risks that we mentioned. And as we know, that played out in the portfolio's favor in time to come. At the same time, we felt from a more within the defensive component of the portfolio that banking on the certainty of the cash outcome, so the cash return, relative to a little bit more uncertainty around, call it bonds or inflation-linked bonds, actually also necessitated an overweight allocation or exposure to cash at that point in time. And then lastly, I guess that's the fourth point, was really one around our offshore allocation. So again, looking at it and how things really stacked up in the beginning of the year, we felt that there was a fair amount of risk from an SA perspective. Of course, the budget, the speech we had in February, together with the looming credit downgrade, both were poised to in some way reflect negatively on the SA economy as a whole. And we felt that the overweight allocation to global assets actually would serve the portfolio quite well. But then, of course, that was, I guess, the view going into the new year, but then into the whole Corona or COVID-19 pandemic. And what we saw subsequent to that is obviously well documented at this stage. But in essence, what it really meant was that these very same growth asset classes that I alluded to earlier sold off quite aggressively across the world. So it didn't matter whether or not you were looking at developed market equities, emerging market equities. They were all pretty much exposed to the same risks. And this flight to quality really saw a lot of cash, both from global and local investors, find their way or move out of these growth assets into what is perceived to be more defensive positions. And I'm really referring to cash, especially from a global perspective, looking at US bonds, for example, and US treasuries. So from that perspective, it's been a risk-off environment. It's something that we experienced from pretty much the latter part of January, going all the way through to pretty much the end of March. So from that perspective, it hasn't been at all pleasant, and I think it's therefore almost it's understandable that clients and investors alike felt an unease around that. And I guess then the question, what pops up thereafter, is what to do next. And really, I think, again, maybe to allude to something that hopefully we'll get a chance to talk about a bit more, is how we put portfolios together. And then how do we effectively merge that forward-looking picture into a portfolio context. Even though we don't have certainty, but at least within a framework of sorts, we can actually portfolio or manage the portfolios and position those portfolios appropriately. Of course, the one thing that I didn't mention was to add insult to injury this time around was, of course, the subsequent oil price wars that we saw between Saudi Arabia and Russia. So as this whole COVID-19 pandemic took hold, of course, that's when these two nations couldn't agree on output levels, and Saudi Arabia, for example, felt that it's better for them to put more oil into the market, therefore increasing their share of the market. And what we saw was the oil price actually falling to record lows, even lower than anticipated. I guess just maybe quickly turning our attention to the markets, and I think the slide will also just put that into perspective. But what we've really, I guess the one part that has really stood out for me over the last quarter has been not just the magnitude of the drawdowns that we've seen in equity markets, but also the pace of which global equity sold off. So as you can see in the slide, what we showcase there is really the pace of which equity markets move from bull to bear territory. So that's typically described or defined as a 20% move in that direction. So it took us a mere 16 days to move from bull to bear territory during this crisis, which is staggering if you compare that to whether it's the dot-com crisis, whether it was 9/11, whether even the global financial crisis. So those 16 days were actually the quickest fall outside of what we saw early in the Great Depression. And this, of course, looks at the S&P in the US. At the same time, we also saw, as I mentioned, a flight to quality, and therefore the risk appetite of investors also soured towards emerging markets. And what we've seen was significant moves out of dedicated EM-focused portfolios globally, where in some instances during certain weeks we actually witnessed outflows of as much as $20 billion during certain weeks. Then looking at it from a market perspective, I guess we saw pretty much the same situation or experience play out domestically, rather than or compared to the offshore counterparts, with the added complexity of also experiencing the Moody's downgrade towards the latter part of March, where of course we saw bond yields move quite aggressively higher. In other words, you see a reduction in your capital value. That certainly also didn't help a diversified portfolio, at least not over that short term. At the same time, The Reserve Bank stepped in to facilitate some liquidity, as we saw that dry up a little bit in the market. And then from a consumer perspective, of course, I guess this is purely from a consumer perspective, a bit of a silver lining to this dark cloud was in fact the 200 basis points interest rate cut that we saw during this time as well. And of course, we know domestic property was hit really hard, especially from not just from a market perspective, but also from the primary and secondary effects of the continued lockdown that we experienced. So all of that really culminated into, as I mentioned, a really bleak picture for domestic growth asset classes, as equities themselves delivered a negative return of 27% over the quarter. Domestic property didn't fare much better either, down more than 40%. At the same time, as I mentioned, with bond yields moving aggressively higher, we saw negative returns being posted by nominal and inflation-linked bonds. And then lastly, I guess, again, maybe a little bit of a positive was how the rand weakened and the impact it had on the rand returns for global assets. That, of course, softened the blow quite considerably for the offshore equities and actually helped propel offshore bonds quite a bit higher. So if we just look at, for just to again illustrate the experience we saw, and for me, which is also, it's a personal lesson, and I guess it's a lesson for investors as well, is to, through these crisis times, to almost work against and guard against knee-jerk reactions. And what we can see on the slide has really been the progression or almost the return profile of the majority or the main asset classes between the 1st of January this year towards the latter part of March. And we've spoken about the returns themselves. And I think it's very easy for clients at that point in time to feel the urge to do something. But as we know, timing the market is extremely difficult, if not impossible. And if we just flip the slide, what you then immediately see is, of course, the recovery we've seen in both domestic and global markets post the latter part of March, going into April. So, and the year we're looking at returns of between 20 and 30% off a lower base. So even though we haven't recouped the losses that we experienced during the sell-off, there has been some of that pressure has been relieved to a large extent. But again, it shows that, almost capitulating at that point where things feel a little bit out of control, it's very important to stay the course again, because then missing out on the upside, whether it's a 15, a 20 or 25% uptick, is very detrimental to one's longer-term investment plan. So I think just looking at it and maybe just to summarize for I guess coming back to your question, Andy, it's been extraordinary. It's been interesting. It's been riveting to say the least. And I guess now we need to look at what we do going forward as well. There's sure to be some uncertainty around valuations as the market tries to almost look through this crisis and look through earnings and dividends to find a new normal, at least for the foreseeable future.
That's amazing, Yaku, considering both the speed and extent of the drawdowns we've experienced. Now, considering that momentum focus and target fund of funds are multi-asset solutions, how have multi-asset class solutions experienced the most recent drawdown? Are there similarities to previous crisis events? What are the lessons that we can draw from these experiences?
Look, I think it's important to, again, just, before we talk about and delve into some of the experiences of late, it's for me always important for a multi-asset class solution, I guess, to refer back to what's most important in terms of both the experience as well as the objective. And what I've shown, I think it was in the previous Outcome Matters session we had, was really how big a role or an important a role your asset allocation decision makes. It's of critical importance whether or not you are exposed to equities versus property versus bonds versus RLBs, rather than selecting manager A versus B versus C versus D. It's got so much more of a not predictive capability, but rather it's got such a big role in terms of your performance outcome at the end of the day that it can't be ignored. Now, looking at the momentum focus and target fund of fund ranges, of course, we do have the 5 risk profiles, every single one of them with a very specific investment objective and risk objective at the same time. And what I've just illustrated with this very straightforward slide is really how we divide the portfolio between these defensive and risk assets. Now, as you would expect for portfolios with a higher inflation or a higher performance objective, of course, there you need more assets with an inflation beating capability. So in modern investment times, that relates again to the growth asset exposure. So you do need an allocation to equities, both domestic and offshore, to property, domestic and offshore, to drive those returns. So it is therefore expected that some of these portfolios with a higher growth asset class exposure will typically exhibit more volatility and variability over the shorter term. And as time goes on, and as you near longer term investment terms and objectives, those returns tend to moderate. Because as we know, and as we've experienced now over the last month or so, there will be some bumps in the road. And that's I guess that's the nature of investing as well. On the opposite side of the spectrum, where I guess we favor or we target lower performance objectives or returns, but we earn a side of caution in terms of the variability in that outcome. So there we include a much higher allocation to defensive assets. So maybe just to set the scene, I guess it's important for me to just relate back or just focus again on the composition of these portfolios. So if we look at the progression, or again, as we look at the experience, I guess, over the last quarter, what we've really seen is how these portfolios participated in the drawdown. So on the slide, on the screen, you'll see that what I've plotted there for illustrative purposes is just how both the equity and the domestic property market have fared between the 1st of January up until the end of March. And then I've just illustrated again how 3 of the risk profiles, call it the Focus 3, 5, and 7 portfolio, actually experienced that very same drawdown. So again, looking at it from this perspective, those portfolios participated, or their participation in the drawdown was limited to between 40 and 75% of the equity drawdown, if I just use domestic equities as a proxy. As I mentioned, I know we experienced a reprieve or a recovery post that, and what you'll see then is that very same recovery for those 3 portfolios relative to equities were in the order of 50 to 80%. So again, with these portfolios being market linked, we are to a large extent also subject to some of the volatility that the market introduces. I think from a portfolio management perspective, at the same time, it's perhaps then also a good point to think about, or to talk about some of the portfolio management activities that we engaged in over the last month or so, as we navigated through the eye of the storm. And I mean, maybe just to highlight a couple of things, what we have done is we have selectively reduced our property exposure further, where liquidity permitting, of course, because what we have witnessed is, of course, the forward-looking prospect for domestic property has deteriorated even further than we anticipated earlier in the year. And now also looking forward and looking through this, we actually see more risk in that sector or that asset class, and therefore we redeployed those assets away from domestic property. At the same time, as I mentioned, we experienced quite a depreciation in the local currency to the points where certainly on our medium-term outlook, the rand has sold off quite aggressively and perhaps a little bit too much. And from that perspective, we felt it's prudent to really do 2 things. The one was to repatriate some of the global assets, which we deployed domestically into defensive assets. And the second was to also introduce or incorporate a currency hedge on the portfolios. Not significantly that it's going to materially affect the profile of the portfolio, but at the very least to give investors some protection should the rand strengthen from these oversold levels. At the same time, just looking at purely from more of a mandate perspective, we've also allowed some of the managers through which we execute on the domestic equity side to, at these times, also maintain slightly higher cash balances within those portfolios. Again, it just gives managers some room to maneuver should opportunities arise, and that from that perspective, we also felt it's prudent. And second to that, we've also allocated more assets or managed the portfolio in such a way where we have a larger allocation to quality. So quality from an equity perspective. So a lot of the holdings in our portfolios are more slanted towards shares and instruments and counters that have stronger balance sheets, where there's more visibility in terms of earnings going forward. And perhaps in certain cases where COVID and secondary effects thereof are expected to be less pronounced. So from that perspective, I guess it also gives some stability and protection, albeit from an equity perspective. If we look at maybe just, again, I think it's important, as I mentioned, to try to understand the past. Not to say that the future will repeat itself or the past will repeat itself, but at the very least to understand how, from a multi-asset class perspective, how portfolios react and how asset classes react. So on the slide on the screen, what we've done is we've looked at 3 previous crisis periods that SA investors experienced. So that includes the Russian crisis from 1987, the dot-com bubble, of course, towards the beginning of 2000, and of course the global financial crisis. Now, I think what's different between these 3 and the corona or COVID-19 pandemic that we're experiencing currently is, of course, that every single one of them occurred for very different reasons. Whether it's economic, whether it's a more of a safety, personal kind of pandemic and crisis that we're facing currently, the underlying reasons were different every single time. And therefore, it's also understandable to expect portfolios to behave differently, and for certain asset classes to recover or to experience it differently, and then their path to recovery to be slightly different. I guess for me, the takeaway point from this perspective is, as you can see, that through pretty much all those periods, we've had local equities and local properties sell off quite aggressively. The global financial crisis was probably the poster child for financial crises in the modern era, and as you can see, again, and I think this ties into the point I made earlier, that staying the course is ultimately your best form of defense. Again, looking at it from a recovery period perspective, it is expected to take some time. I mean, as we can see, whether it's for both the Russian crisis as well as the global financial crisis, it took equities around a year to recover to the levels that they were at previously, prior to the crash. For property, it was pretty much around the same time. But very importantly, I think if we look at domestic bonds, that in all 3 of those scenarios, we saw domestic bonds sell off between 5 and 7%, or for the 2 major crisis periods. But then their recovery was quite swift. So again, from a portfolio perspective, if we look at it from that perspective, it's important to understand that, yes, we will have these bumps in the road. And certainly from a financial planning or portfolio management perspective, we need to appreciate that these events will occur from time to time. But we need to appreciate at the same time that staying the course does pay dividend. As you can see, the 30-year returns for those asset classes historically has still been way in excess of inflation. So even though things from time to time may seem, we may see the dark clouds on the horizon, we need to look through those and have exposure to a range of asset classes for both their characteristics in terms of their protectionist or protection capabilities, as well as those inflation beating capabilities that I mentioned earlier. So I think, just out of interest, what you'll see on the screen is a slide I put together just to maybe look at whether or not March was any different from anything we've experienced previously. So as you'll see in the red bars, which represent the average return for the various asset classes, looking at the 20 worst equity months over the last 20 or so years. And as you can see, during those periods, domestic equities sold off quite a bit, so on average about 7%. But then all the asset classes delivered a diversified return. So global equities, domestic properties, sold off less aggressively. And what we saw was between bonds and ILBs and offshore bonds, those asset classes during those times actually delivered a stable or zero return. If we then look at March, I think you can again appreciate the extreme event that we actually just experienced. So for March, of course, equities sold off close on 16% for the month alone. That then takes into consideration the sell-off towards the beginning and the recovery towards the end of March. But at the same time, domestic property, as we know, was unfortunately hit even harder. And then very interesting for me during this period was not just the speed again, as I mentioned, but also the magnitude of the sell-off that we experienced in both domestic bonds and inflation-linked bonds. Of course, those two asset classes recovered quite a bit post-March, as I showed earlier. So I guess for me, again, the takeaway point here is that every crisis is different and the market experience is different. So for me, looking at March on a standalone basis, I think that explains a lot about how multi-asset class funds in general, including our own, actually were placed under pressure, given that very few asset classes, with the exception of global bonds, delivering a positive return. At the same time, I also believe that, not knowing the future at the same time, it's also prudent to have exposure to these asset classes, given that their profiles have shown in history to be very different, and that you still get those defensive characteristics from, especially those defensive asset classes. If we look at it from a portfolio perspective, for me, this is equally important. I mentioned earlier that through an outcomes-based philosophy, how we actually construct portfolios. So therefore, this slide just puts it into perspective. If we look at it's something that we call a bull-bear analysis. So we look at all the asset classes, or we look at our strategic asset allocations for our various portfolios, and we look back into history, for example, how those asset classes performed over the last, call it 50, 60 odd years. And what you find through this analysis, and again, I'm using domestic equities as the base effectively. So what you'll see on the left-hand side of the graph is really that when domestic equities on average perform negatively, how the various risk profiles perform in turn, given their diversified nature. And at the same time, when equities do well, you would naturally expect the portfolios to do well. But again, looking at it from a risk profile perspective, the more aggressive portfolios, call it the Focus 7, Docket 7, or even 6 and 5 portfolios, tend to keep up better when equities do well. So unfortunately, we're in a period of time now where equities aren't doing well. And I think we have experienced something very extraordinary within March specifically. But the portfolios are built for a longer term horizon. And yes, as I mentioned, we will have these bumps in the road along the way, but certainly the robust portfolio construction methodologies is very much embedded in these portfolios, and the allocation to those asset classes remain intact, and their characteristics will come to the fore through time.
Let's turn our attention to the next 6 to 12 months, shall we? If we look into a proverbial crystal ball, what is Momentum Investments' view for the foreseeable future during and post-COVID-19? And how does this view inform your portfolio positioning?
I think we've spent, certainly in our engagements with clients, this has been one of the parts for me where I think we need to spend a lot of time. We need to understand, or try to at the very least understand, how we see the world playing out over the next 6 to 12 to 18 months. Now, forecasting is notoriously difficult, if not impossible. We can't with 100% clarity and certainty say where the rand's going to end up in a year's time, nor exactly where equities will end and so forth. But for me, what is important is for us from a portfolio management perspective, and I guess also from a expectation management perspective with clients, is to help to formulate or at the very least distill everything we know into a framework that is more focused and thought through. So what I want to actually share with you, Andile, is, and of course with everyone on the call, is really how we see things shaping up. Now, this is more based on economic fundamentals and changes rather than necessarily looking at equities or property or bonds for that matter. Because what we have seen historically, and I think, a lot of what we've seen over the last 10 or 15 years is that quite often markets don't necessarily reflect the fundamentals. I think we've gone through quite a couple of phases. If I think about the domestic economy and the domestic market, where markets may have done well when economic fundamentals weren't that great. And from this perspective, what I really want to talk through today is, and very briefly, is just how we see the local economy playing out over the next while. So what we've done, and this is in collaboration with Herman and Sanisha from more an economic and a strategist perspective, is to see from a probabilistic perspective which roads to recovery can we either look forward to or expect in the coming 12 to 18 months. Now, as you would expect, the V-shaped recovery, which is also colored in green on my slide, represents what the best case is. Now, we certainly experienced a V-shaped recovery, I guess, from a market perspective. Just looking how quickly things certainly fell during the latter part of March, and then our markets recovered from the latter part of March into April. So markets seem to have provided us with a V-shaped recovery from a pure investment perspective. However, from an economic perspective, it's not that clear cut, and that's why we say it's the best case. In other words, it's the best of all. It's the best way of us getting out of the current recession that we're in, and typically looking at previous V-shaped recoveries, there are certain things we need to look at. Now, from a pure pandemic perspective, as we find ourselves in now, those recoveries that we've seen were typically boosted or at the very least informed by anything from a pharmaceutical breakthrough, a highly effective vaccine, for example, that was brought to market that would have helped to alleviate some of those concerns. At the same time, with that, so with those vaccines or recoveries, quarantine measures like the ones we have and that we are experiencing now will be done away with very quickly. So it's not this protracted, staggered even alleviation of lockdowns. In a V-shaped recovery, you need a vaccine and a very short and immediate suspension of any of these methods or quarantines that we are seeing currently. In this case as well, if we look at it from a pure economic perspective, should this picture effectively manifest itself, we see economic recovery or economic activity resume very quickly towards the middle part of 2020, so within the next month or two. So that's why I'm really saying this is the best case. We do assign a lower probability to this, however, just given everything that we've seen, experienced, and what we are looking forward to. I guess our base case, which is in our view the more realistic way out of this current situation, is through a U-shaped recovery. Now, what a U-shaped recovery really lends itself to, in a nutshell, is that as we are seeing now, across the world, you'll see peaks appear in terms of infection rates, but also then recovery rates, as we've seen going from China, for example, into Europe, into the US. What the U-shaped recovery is also based on, however, is that as you go through this process, you don't get reinfections. So you don't get secondary impacts or effects of people being reinfected and you're having to go through this whole process again. If we look at this from an economic activity perspective, we are only likely to see growth in economic activity pick up towards the fourth or third quarter latter part of the third quarter of 2020. So what this really means is that we go through this recessionary phase for the next couple of months, and only later do we see a gradual uptick and a recovery of economic activity. It's of course still very unpredictable and data dependent. I guess call it the bear case scenario, which is the one that we've got in the orange color, is really shaped, or it's really focused on a U or W-shaped recovery. Now, I alluded to it just now in that what those profiles look like is very much the U shape as we're going through now, but then we get to a point where perhaps there are broader global reinfections. So effectively, you're turning back the clock and you're doing everything over again. So therefore, the economy starts to recover, you get a high infection rate, and you go back to where you were. So that then forms a bit of a W, effectively. And from an economic activity perspective, it's also quite detrimental to economies, because what you do is you starting up economic activity, and shortly thereafter, you have to scale everything back again. And in that scenario, I guess you will only see true and sustained economic activity pick up towards the latter part or the early part of 2021, really. And certainly not the one that's conducive to growth markets at all. And then the last one, which what we call is the L-shaped recovery. Now, I think Sanisha mentioned this, and McKinsey calls it the black swan of black swans. And really what it really means, this is almost I dare not say it, but an all fall down scenario where global economies or global activity is decimated for an extended period of time with no real possible shorter term or medium term recovery. So in other words, economic trade is severely hampered across the globe, and it's sustained at those low levels for quite some time. And I mean, it's very difficult to even put a timestamp on it. But the reality is that in that scenario, you'll also find that global growth reduces significantly. It's economies and countries become more inwardly focused than they have been over the short time. And in that scenario, it's really detrimental to both financial markets and, of course, to investments. Of course, as I mentioned, we're looking to a U-shaped recovery. So as things stand, we typically look towards the next couple of months of being in this recessionary phase before things tick up. And I guess that's also, as I mentioned, where financial markets will look to find and establish some kind of base. There's a lot of forecasting error at this point in time because we don't know how companies are going to, when they do report earnings and profits, we don't yet know what the impact of the COVID-19 pandemic and subsequent lockdowns really means for them from an earnings perspective. So from that perspective, just looking at purely from portfolio management perspective, it's fair to say that we continue to manage the portfolios on an actively managed and a very call it ear to the ground basis, and really looking forward through the next couple of months. It's therefore for me appropriate for us to maintain an underweight to these growth assets that I've spoken about today. Again, most importantly, because we don't quite know what the path to recovery will be. So you have to have some of these growth asset class exposures in your portfolio for their inherent characteristics, but at the same time, you have to be cautious. I think it's fair to say that, yes, markets have done quite well post the latter part of March into April, but it's at the very least unprecedented to see markets do this and continue to build on this, given everything that's happening. Herman, for example, we talk about, this is not a single, call it earthquake or natural disaster that happened and passed. These are, in actual fact, events that would have happened and continuously happen in a smaller scale. If I look at, for example, infections. The infections are continuously there and rising in certain cases. So from that perspective, the market is perhaps a little bit too optimistic in terms of some of those returns. And I mean, even if we look at it now from on the US, on the S&P, we've moved from a phase, or from the peak, equities are down close on 15% at this point in time. And it feels as if that is not enough of a correction given the wholesale or wide-scale disruption to economic activity. So purely from that perspective, we're very comfortable to maintain that underweight exposure to growth assets relative to defensive assets. At the same time, we continue to hold or manage the portfolio in a way where domestic equities are favored to domestic property. We will at the same time, given where yields have moved and the valuations on domestic bonds, continue to hold an overweight exposure to bonds, especially now that cash has, given a reduction in interest rates, that we see a reduced return from cash. And at the same time, as I mentioned, we'll also look at a more neutral position between domestic and offshore assets as well, as we repatriated some of those global assets given rand weakness. So I think maybe just in summary, Andile, if you would indulge me for just a second or so longer, I think for me the main takeaway points at this point is that from a portfolio management perspective, the team is as committed and as driven to manage these portfolios in a manner that is responsible and in line with what our objectives are. I think working from home has really not actually changed life a lot. If anything, the energy levels are up and everyone's state of mind is good and strong. And from that perspective as well, the commitment that the team has shown has really been fantastic, especially looking at from my team's perspective. And I guess from a planner and from a advisor perspective and from a client perspective, what we have experienced has really been out of the ordinary. It's something that very few of us, I guess, experienced to date within our working careers, whatever they may have been. And as we've seen how quickly things have changed between Feb and March, they've changed as quickly between March and April. So again, it talks to me about staying the course. Of course, looking at the way we manage the portfolios. Of course, there's an actively managed portfolio there. It's something that we're managing through this, navigating through the storm. I saw a quote that relate to everyone being in different boats, but we're all being in the same storm. And that for me is very true. And that's why, we're trying to make this as comfortable as possible. And I mean, at the same time, if you feel you need to reach out to the team, please do so. And we'll be happy to oblige with any comments, any interactions that may be necessary. But I thank you for your time, Andile, and of course for everyone dialing in. I really appreciate it. Take care, stay safe, and I hope to speak to you soon.
I am going to move on without any further ado and introduce you to Ian Scott. Ian is Head of Fixed Income for Momentum Investments, and I'd like to welcome him to the screen. Welcome, Ian.
Good day. Thank you for joining me, Ian Scott, in our discussion around fixed income and particularly South African fixed income.
Ian, how do the changes in world fixed income markets and central bank actions play a role in the South African fixed income market?
Let's start with the Fed. Fed sets the base rates in the world. What are we seeing at the moment that the market is expecting? Well, the market is expecting the Fed to probably remain on hold for a very long period of time, maybe for the next 2 years. Rates in the US are going nowhere. Remember this, the Fed cut the rates to 25 basis points. They are going to increase the balance sheet exponentially. They're buying assets in the market. This is quite important for the base rate in the world. Global interest rates aren't really going anywhere. We've seen it with the ECB and all the major central banks. Just for interest sake, the rate cut that we saw in April was the 100th rate cut by a central bank in 2020. That is amazing stuff. Right, to move on. So yes, March was very painful for all of us. What happened? March was not a repeat of 2008. 2008 was what we call a solvency event. Valuations just got too expensive. March 2020 was a liquidity event. We saw that even the US bond market became illiquid. The South African bond market became illiquid. It's a very, very different environment than what we've seen. It's not the same as 2008. When liquidity moves away from markets, prices fell, and that's why it fell so rapidly. So if we move to the US yield curve, what happened? So the Fed cut rates to 25 basis points, and they said, look, they're going to buy all sorts of bonds and credits to help support liquidity in the market. It's quite important. What happened to the US Fed curve is what we call a bull steepness. So the short end moved a lot more than the longer end. Why? Because the Fed cut rates so aggressively. If we then move to the expectations of what does the market expect of inflation and growth in the US, you'd see what we call the five-year forward breakeven. It actually measures where the market thinks average inflation will be over the next 5 years in the US. So just to give you an idea, we've been in a low inflation environment now for quite a while, and in the US, the average inflation has probably been around 1.6. Over the next 5 years, the market expects inflation to be less than 1.5 in the US, probably a lot lower than this year. So it says to you, there's not a lot of inflation expected in the US. It's good for bonds. Remember, low inflation is good for bonds. If we look at the high yield curve, now this is where non-investment grade corporates trade in US dollars. At one stage in 2018, they traded at a premium to US treasuries. Have you ever heard credits trading at a premium to governments? That just does not make sense. What we've seen in March was what we call a derating. Spreads widened significantly, making them a lot cheaper versus US treasuries. So now we think credits in the US are priced a lot more attractively than where they were. If we move across the Atlantic Ocean to Europe, what's happening in Europe? Well, in Europe, we know that the ECB cut rates a little bit further, but remember they are negative. But the main important instrument they use is going to be buying more government bonds in Europe. They're even going to buy Italian bonds. Can you believe it? Which will mean that what we call a curve bull flattened. The long end of the curve moved a lot more than the short end of the curve. What does that say to? It says to it's a good environment for bonds. The bond market in Europe is not concerned around inflation and is very concerned around growth in that market. So are we surprised when the ECB comes out and says, we'll do what it takes, what's necessary? These are important words from central banks when we hear them. So most developed market bonds have obviously rallied very hard, but what have we seen in emerging markets? Well, in emerging market yields, they've shot up. Think about it. The 10 years moved from around 9% to 12.5%. That's massive. It's 350 basis points. And we've seen it across EMs. Why? Because liquidity went out of markets. There was fear in markets. Get out of EM and get into developed markets again. We think South Africa took an inordinate amount of pain. We look like Turkey, yet Turkey is rated 2 notches below us, even after junk. So we think because the South African market is liquid, we took a lot of pain. Foreigners just wanted to get out of South African assets, and that's what happened. Our bonds are very, very cheap in relation to emerging market yields and in global yields.
We've seen the ratings downgrade and all the negative news around the economy. Is there an awful down scenario for South African bonds?
So if we look at our own yield curve, remember a yield curve is a term structure of South African interest rates. Our curve is very, very steep. So I said to you in developed markets, the curve flattened. In South Africa, our curve steepened. What does it mean? It means short end rates rallied a lot more and high end yields, the longer end yields actually went up. So that we at the moment have a 3% gap widening between, let's say, a 10 or 5-year bond and a 30-year bond. There's about 300 basis points. Now that curve is way too steep. It's worse than 2008, and it happened over a very short period of time. So if we look at our sovereign spread, what we call our CDS spread, so basically where South African debt trades in dollars, we've seen that spread has probably moved in excess of 400 basis points. We look even worse than Turkey, and as I said, Turkey is worse rated than South Africa. So we've seen an important amount of South African selling of our dollar debt, which we think is not warranted given our fundamentals. So what does it mean for local markets? So if we move to the South African money market, I think it's quite important that you also see that our money market curve is steep. Well, firstly, why? Because the SARB has been cutting rates. We've seen 225 basis points of rate cuts so far. That's shortening the curve. And obviously, in the long end of the curve, banks are still incentivized to fund their deposit base longer, so they pay up for longer-term funding. So that's why South Africa's got a very steep curve. And we think that's a big opportunity in the South African cash market for investors that want to be conservative and put their money into cash. Now moving to the bond market, and yes, it's the sovereign downgrade, and there will be hundreds of billions of rand flowing out of South Africa when we get jumped and we'll fall out of the weekly index. Well, we've seen it. We've seen foreigners now net sellers to the tune of about 60 odd billion of South African bonds year to date, not the hundreds of billions. And yes, the foreigners have probably moved from being holders of about 37% of South African government bonds to around 32, 33% as we've seen. But remember, these market events are well priced. So the market was already preempting that there would be a selling. And everybody said, well, the end of April was going to be disaster in the South African bond market. Well, we haven't seen it. In fact, in the last week of April, foreigners were net buyers about 4 billion of South African bonds. So it says to you, a lot of these market events are actually well anticipated and well priced. So if we move to the South African yield curve, we can see it's very steep, as I said to you, the 5-year to the 30 or 300 basis points. We think it's too excessively priced for negative risk. What do I mean? I mean, in that steep yield curve, it already says, well, we know that Eskom is bad. We know that government finances are bad. We know that South Africa is not going to grow. There's going to be a big budget deficit. But that's too steep. Because let's put it in terms of the reality of South Africa. So we believe that the economy could probably shrink about 5% this year, and inflation could be lower than 3%. Now, if you say, well, inflation is 3% and the 10-year yield is 10.5%, well, that's 7.5% real. That's equity-like real yields for bond risk. And that's why we think South African bonds look very attractive for investors at this point in time. So if we look at our fair value, and we always say, well, where do we think our fair value should be? And we get to around 10.5%. Currently, we think that's probably at fair levels. But these are the curves. These aren't our own forecasts. So it says to you the market is basically pricing a lot of negative risk in South Africa where US treasuries have gone negative. We've put it as a zero in our model. But you can see the market is pricing for excess of 6% inflation, where we think inflation over the next 1 to 3 years could be 3, 4, maybe 5%. So if you already say, well, the market is pricing for excessive inflation, our fair values could be lower. And when fair values are lower, it means we'll get good returns out of bonds. If we now move over to inflation-linked bonds, well, what's the reason for buying inflation bonds? You want to protect your savings against the negative effect of inflation. But now I'm saying to you, there's going to be very little inflation, very little growth. Why do you want to protect your investments against inflation at the moment? We think inflation bonds are probably our least preferred asset class at this point in time. Why? Because you don't need inflation protection. Inflation is going to be 3 and lower. You're getting high real yields from nominal bonds. We think that the real yields that you get out of inflation bonds sitting at around 4.5% is too low. If at 7.5%, you're getting that high real yields from nominal bonds. So we'd rather be in nominal bonds than inflation bonds. And secondly, inflation bonds are typically also a lot more liquid, harder to trade, and the prices can be volatile in that market versus our nominal bonds. We're also seeing that demand really fluctuates, and there's issues around trading inflation bonds because you get a lot of buy and hold investors in that market. So yeah, we'd be a lot more circumspect. There's a time and a place for inflation bonds, but not an environment where you're growing at minus 5% inflation, it would be sub 3%. Inflation bonds is where you buy when inflation is expected to breach 6% and the economy is going at 3 or 4%. We think that's a good environment for inflation bonds, but not at the moment. So when we talk around the credit market, sure, this has been a hard one because if you think about the South African listed credit market, it issues around 150 billion worth of credit every year. Last year, we had a massive issuance year of nearly 170 billion. This year, it was expected that we would issue around 150 billion, but down to COVID-19. Issuance has basically stopped in the market now since March. We're not seeing a lot of issuance. We see that credit issuers actually come and talk to us on a bilateral basis, where they want to issue on a deal-based basis to us. So we don't expect a lot of credit issuance this year to come out. What we have seen, though, is that credit spreads widen. Now, you would have heard me in previous presentations say that we're very circumspect around the South African credit market. We were very concerned around the South African credit market. Why? Well, firstly, because credit quality is deteriorating. We're seeing a lot of companies under balance sheet stress. And secondly, the pricing of credit was not attractive to us. Now, remember, in our philosophy, pricing is very important. We want to buy assets when they go on sale, not when the market is on fire and prices are high. So what we've seen over the last 2 months or so is that spreads have widened significantly. And it started, not surprisingly, in the lower quality parts of the market. Now, when we say lower quality, we mean the more risky debt. So where was the more risky debt? What we call bank 81 debt. That's basically nearly equity type debt in the banking capital structure. Bank sub debt, so lower quality debt. We've seen those spreads probably widen over the last 2 months, about 200 to 300 basis points. Now we've seen that the spread widening has migrated up to the high levels of credit, where bank senior debt is probably moving 80 basis points higher. Your industrial type credits are probably moving 100, 150 basis points wider. We are still waiting to see where the property companies are going to issue, because we know there's big issues there. But we think this is a great opportunity where for the last 2 years, I've been very circumspect and say, be careful when you go into credit. We think there are great opportunities in the credit market now for investors, especially looking for opportunity that's a bit above cash. You're not taking a massive amount of interest rate risk, but we think there's a good opportunity in the credit market to return high type yields without taking an excessive amount of risk. So we are getting very excited about the secondary credit market. We're seeing good quality names where the spreads have widened and the prices have fallen to pick up the opportunities. But we obviously have to be careful around what we're seeing at the moment, because credit quality is deteriorating. If you look at the graph, you can probably see when it moves up, it means that balance sheets are under fire. There's a lot more pressure coming up. And it's not going to be equal across the whole credit market. We know that there will be pockets of credit which will be okay. And we think there's pockets of credit that will come under severe stress. So, for example, we think that the property sector will feel a lot of balance sheet stress, because we know what's happened to shopping centre. There's a problem with rentals. We also are concerned around what will happen with the non-performing loans in credit retailers, as well as non-performing loans in banks. I'm not saying that banks will fall over in South Africa, please. Banks in South Africa are very well capitalized, but we have to accept that there will be more non-performing loans, and credit quality of our banking system, of our industrial sector, and especially of our property sector will be a lot worse than where they were. But this is a good environment for stock pickers like ourselves looking for good opportunities. As I always say, in investment, we're like miners. We have to sift through 10 tons of rocks to find that 1 or 2 diamonds, and that's what we do on a day-to-day basis for our investors.
All right, so Ian, we're here now. How do we monetize this fixed income opportunity to the client's benefits?
Well, we're in an environment where inflation is low, growth is low, and real yields are high. I think this is a very good opportunity to lock in high real yields for investors. There's a big tailwind in it. Why? The SARB has cut rates by 225 basis points. We're expecting another 50 to 100 basis points of rate cuts. Inflation is falling. Growth is very negative. So a lot of tailwinds for South African fixed income. I also made the prediction that South African fixed income may be the only asset class over the next 1 or 2 years that will actually give you an income. Why? Because what's happened on the equity market? Most dividend distributions have been stopped. What's happened in the property market? Most distributions from property companies or REITs have been stopped. But they have to pay us our coupons. As fixed income investors, they have to pay us our coupons on time. Otherwise, it is a default. So we believe that fixed income could be a great place in portfolios and client portfolios if you are looking for income. I think for the first time in many years, fixed income will deliver on its name of income. And I think it becomes quite important in these times to actually have income. And my last point to always say is that remember, in times of stress is when the best opportunities are found. Yes, it doesn't feel right and there's all sorts of issues around South Africa, but remember, it is already reflected in the price. When our 10-year yield trades at 10.5% and the long yields are trading nearly 12%, that says to a lot of negative things in the prices. And we always say to our clients, it's in times of these that you set yourself up for the next few years by actually investing in high quality assets at low prices that reflect all these negativities, and just let the market do its work for you over the next year or two. We have to say that the valuation argument for South African fixed income is really solid. We've shown in previous slides that South African fixed income is really cheaply priced. There's real returns to be had at low risk, since all the bad news are behind us. And yes, for investors looking for income, I mean that over the next 2 years, I think South African fixed income will be the only asset class delivering a income through coupons and interest rates. And how does it stack up? So how do we get to the numbers? And forecasting is tough in this environment. So let's start at the lowest risk, at cash or money market, where we believe return around 5.5% over the next year is possible. We move a little bit up the curve, we can talk about credit. We think credit will probably give you around 6 or 6.5% return. If we move to the inflation protection market in South African inflation bonds, we think we can generate returns around 6 to 7% over the next 2 to 3 years. And then our most preferred asset class would be South African nominal bonds, where we think returns around 8.5 to 9% is really possible. Even if bonds go very little down, we'll still generate a high level of coupon, which is around 8%, but we don't have to stretch the valuation to get to those return numbers. I think over the course of my presentation, I've given you a compelling argument for risk-averse investors, as well as investors looking for fixed income exposure, to invest in South African fixed income through the funds. And we would really encourage you to use momentum investments as your exposure into South African fixed income. I thank you.
Thank you very much, Ian. Always interesting to hear your views. I have a couple of questions that pop in my mind at this stage of the conversation. And questions like, what is your experience as a planner been in times like these, especially when engaging with your clients? Have there been extremely positive conversations, extremely negative conversations? How have you navigated those discussions? Have you embraced technology, the likes of Zoom and Microsoft Teams, all the M-Sign and all these other tools that are available to you now? Have those been a smooth transition into your daily lives? Also, I'm wondering what it's been like for those of you who've experienced market crashes before. When economic times were tough, how have you been able to get through or reacted to times like that? Is it useful to have that experience right now? And then perhaps lastly, something I've always been curious about is, what is the toughest part of your day, of your job? What is the toughest thing that you've got to do on a daily, weekly, or monthly basis? And how do you manage it? How do you get past it? How do you get through it? Anyway, without taking too much more of your time, I'd like to introduce Paul Nixon, who's the head of technical marketing for Momentum Investments. Perhaps he can answer some of these questions. Paul, there's a ton of uncertainty out there at the moment. How does this play out from a neuroscience perspective?
Ideally, you've asked a very good question around the uncertainty and a neuroscience view on what's happening to human beings at the moment. I think COVID-19 has really brought two things to the fore. The first is that human beings really, really hate uncertainty. There was a fascinating experiment conducted in 2016 where participants were asked to play a video game. And in this video game, they were asked to turn over rocks. And if they turned over a rock and there was a snake hiding underneath, they received an unpleasant electric shock. Luckily, they could figure out, there was a pattern, they could figure out which rocks had snakes hiding underneath. But at one point in the video game, it was inevitable to receive an electric shock because they only gave you an option where there was a snake hiding underneath. In other words, the participants knew that the electric shock was coming. And when they were examined under an fMRI machine, we can see that humans possess machinery called the locus coeruleus, which is near our brain stems, which is working very hard to try and make unpleasant experiences more bearable. And this was reflected in the results. Participants reported a much less unpleasant electric shock when they knew it was coming. The second thing is that our basal ganglia and our cerebellum are working very hard to use past experiences to create a world that's more predictable. In other words, they're trying to predict, the regions in your brain are trying to predict what's going to happen based on what's happened in the past. So our past is always going to play a big role in our future decision-making, which is also very important from an investing perspective. Now, during times of high uncertainty like COVID-19, your adrenal glands are going to be manufacturing an excess amount of cortisol in response to the stress. So cortisol is a stress hormone, is going to help reduce the stress response. But research published by the Wharton Business School confirms that when we have excess amounts of cortisol in our systems, we are far more predisposed to use our gut instinct. In other words, put critical thinking on the back burner. Now think about that for a second, what that means from an investing perspective. From an evolutionary perspective, that's great. It puts us in a position where we can make decisions very quickly. But from an investing perspective, it really puts us at risk of making decisions that are going to sabotage our financial futures. So what we're saying is that in order to make the world more predictable, our brain holds a rule book, if you can think of it that way, on file, on system. And this is really a belief system about the way the world works. But sometimes our brain is going to convince us of something that isn't really true. And this is really the essence of a cognitive distortion and what we're talking about. Now, there are a couple of very interesting ways that we can show this. So on your screens, you might have read one, if not both of those sentences incorrectly that were displayed on your screen, simply because you've seen the matrix before, you know what the phrase should be, and your brain is actually overriding the incorrect information that's actually gotten through your visual cortex, and it's actually replaced it with the correct information. And this is quite an important point. Your brain is not looking for the truth, it's looking for meaning. It's less interested in the truth and more interested in what it must do with the information that's actually been presented to it. And this is an effect we can see where your brain autocorrects certain things based on past experiences to get you to a quicker decision or to a quicker place to enable you to make a decision going forward. The second thing is we can look at optical illusions. What you can see on your screen now is called the Adelson checker shadow illusion. It may surprise you to learn that both of those squares, at least, are exactly the same color. What's happening here is that the lighter square is in a shadow. Now, what happens in a shadow is your brain is telling you that square is probably absorbing too much light, so it probably should be lighter. But that's not enough to complete the illusion. What completes the illusion is the fact that you've seen a checkerboard many times before. So together with this, your brain is telling you that there's a darker square next to it or adjacent to it, and therefore, together with the fact that this is in a shadow, that square should be lighter. And as a result, you see that checkerboard the same way you've seen every other checkerboard before, again, using past experience. The second thing is the example that we can call the dress that broke the internet. This is a particularly interesting one. How we can actually see one image in two completely different ways. You can see on your screens that some of you, in actual fact, 60% of you in the survey saw this dress as gold with white stripes, while 40% of you saw this dress as blue with black stripes. The dress is actually blue with black stripes, and this example actually came to the fore when a bridesmaid, or rather a bride, was asking about some opinions for her bridesmaid dresses, and it actually became very clear very quickly from the responses or comments that were seen on the page that people were seeing completely different things. What's actually happening in this case is that if your brain thinks that dress is in a shadow, it's going to think it's over-representing short light waves or blue light waves. And if it thinks it's over-representing short light waves, it will actually auto-subtract those light waves out, leaving longer light waves, which of course are yellows and golds. So you would see that dress as gold with white stripes, as we saw in the survey. Fascinating.
How do these cognitive distortions apply to the world of investing?
Andelia, I'm very glad you asked that question because we have some fascinating results to discuss from the survey that everyone or many of you completed on the link to this session. And firstly, a big thank you to everyone for the responses that came in thick and fast. Lockdown apparently is a very good time to do a survey. I don't think I've received responses that quickly before for a survey of this nature. So thank you. But before I get there, I would just like to discuss a brief framework or categorization method around these cognitive distortions, which make them a little bit more memorable and easy to link to the advice process as well. The Organization for Economic Cooperation and Development, the OECD, published a paper last year where they categorized cognitive distortions or thinking problems into 4 things, and they called it the ABCD framework. So let's start with A. Human beings have an attention or a focus problem. Now, this in part is because we're exposed to a lot of information and we're only capable of processing a fraction of that. So the human brain is exposed to 18 million bits of information every second and can process a fraction of this at around 120 bits of information every second. You might be disappointed to learn that a modem in 1989 could process 10 times that at 1,200 bits of information every second. Now, this is particularly problematic in forming our belief systems, because in many cases, our belief systems are predicated or built on the incorrect information or too little information. Now, think about this from an advice or investing perspective. If your clients have been exposed to information around Bitcoin, for example, how well it's done, how badly it's done, they've been exposed to information around other funds doing particularly well, or asset classes, or things that have done very well or very badly in recent times, this information might formulate their belief system, for example, a false belief system that past investment performance is a great way to select investments. Now, this is going to inform their choices or they're going to pick funds or investments that are going to be consonant with their belief system. But ultimately, when they don't get the results that they desire, that's going to affect their willpower, or D, their determination to stay invested in that particular product, fund, or investment. And this really perpetuates the cycle, because obviously then they are going to start looking for things again that have performed well. And that goes back to the beginning, which is attention. Now, belief formation or belief system is extremely important from the world of investing, because this really goes back to a client's relationship with money, for example, for over many, many years, or could at least go back over many years. And I'll give you a practical example from my own experiences. So when I was a kid, I used to, my parents used to drop me off at school in the oldest, most beaten up sort of car, the door was half falling off, and I was mortified when they dropped me off at school. And that really affected me as a child, and it sort of led to a behavior in adulthood where I always seemed to drive a nice car, because that's important to me. Now, any financial advisor can come and tell me as much as they want how bad that decision is, but of course, because of my experience and how I've actually experienced money as a child, that's particularly important. So ignoring that in the advice process is going to really lead to something where I ignore the advice that I'm given. And we can see that the financial services industry and behavior at a client level hasn't changed for many years, simply because a belief system is very difficult to change. So as financial services providers, we're going to have to arm financial advisors with tools and diagnostic techniques where we enable the right conversations with clients around the psychological dimensions of financial planning. And that's really the point I'm trying to get across here. But let's move quickly to the survey results. Some very interesting results indeed. Now, the first one I'm going to talk about is the Donald Trump statement. We're going to start with belief formation problems. Now, it's quite difficult for me to assess an attention problem in a survey without taking control of your webcam and using some eye tracking software, which I'm pretty sure is illegal. So I will start with B, which is belief formation. So what we did was we gave you a picture of Donald Trump, and then we gave you a statement with that picture. Western European countries pursue an unstable economic policy. Now, only 20% of you agreed with this statement, with the picture of Donald Trump. Now, what makes this particularly interesting is it's related to something called the messenger effect. And what I did was testing this on another group of people, I put exactly the same statement to them, but I changed the picture and I put Barack Obama's picture next to the statement. And of course, we had a complete preference reversal where 60% of the audience or picture in that case agreed with the statement. So this gives us a nice example of how our brain takes shortcuts. Instead of evaluating or critically evaluating the statement, it's much easier to evaluate the person. So if we like the person, we think that what they're saying must be true. And this is really, we've seen this, advertisers taking advantage of this in the 50s and 60s, where doctors and dentists used to endorse smoking, for example. We're still on belief formation problem around the driving scores, right? Wow. So the average score rating your driving skills from 1 to 10 is 8.7. So we are clearly amongst some very, very good drivers here. Now the problem, and this is a very normal response to this kind of question, and the reason why we do this is related to overconfidence. And the reason why we're overconfident is because we don't use objective measures to evaluate ourselves. For example, like checking our blind spot. We're very good at creating our own evaluation systems, which aren't linked to objective measures, to protect our egos or self-esteem. Now, there was a very interesting study published in the United States where people actually, for example, some people actually rated texting and driving as a positive. In other words, it was a skill. It made them a better driver. So we like to evaluate ourselves on we might evaluate ourselves on how many accidents we've had, for example, which also may be a reflection of other people's driving skills. Now, this is also particularly important to the world of investing because we need to rate our success with our clients in terms of how often they're able to reach their investment goals, because that is the objective measure. We need to get clients to their investment goals, and that's really the only objective measure of investment success. Next, we talked about the virus outbreak. So we gave a bit of a case which is all too familiar at the moment. There's a disease outbreak expected to kill 600 people if no action is taken. You basically have two options here. You can save 200 people with option A, or option B gives 1/3 probability that 600 people will be saved and a 2/3 probability that nobody will be saved. So what we can see here is a normal response where we are risk averse. So 62% of you actually opted for option A, which is the safe option, right? So we're banking the saved lives here. We don't want to take any risk that nobody will be saved. Now, the interesting thing here is that when we actually rephrase the question, not in a positive light, but in a negative light, the preference is reversed once again. So when we said the virus mutates, now adopting option A means 400 people will die, and option B gives a 1/3 probability that nobody will die and a 2/3 probability that 600 will die. And if you actually read this sentence again, this is exactly the same as option A. The only thing that's changed is that we phrased this in a negative instead of positive way. In other words, we're saying that option A means 400 people will die, which is actually exactly the same as 200 people will be saved if you look at the total population of 600. And in this case, nearly 60% of you, again, became risk-seeking. So you were willing to take risk to avoid the fact that 400 people were going to die. Now, this is very interesting from an investing perspective because during times of uncertainty like this, there's an important principle at play here. When your clients move into the loss zone, they are going to be very, very willing to take risk to reduce or eliminate those losses. And this is really the effect that we see at casinos as well, called the double down effect. Clients are going to be willing to take risk if it means avoiding a very painful loss. Right, next we have, so we've just dealt with choice problems, which of course are related to preferences and the way we frame things. The last one is determination problems. And this is really, again, a willpower issue. And here we asked which would you prefer? You could receive 10,000 Rand in 26 weeks or 11,000 Rand in 30 weeks. Which would you do? So that refers to an outcome that's happening in the future. And in this case, 60% of you chose to rather wait and get the rather good investment reward. So you were very happy to wait if that preference happened in the future. But the minute we reversed that and asked if you would prefer to have 10,000 Rand now or 11,000 Rand in 4 weeks, exactly the same period of time, the preference was reversed and 58% of you chose rather to consume now. So what we're actually saying here is that saving is a great idea as long as we don't have to do it now. And this is really something called hyperbolic discounting, which is just a sort of a fancy way of relating to our very wonky discounting systems as human beings. And then this is also another reason we have treadmills collecting dust in garages, and we watch Netflix on the couch instead of exercising. Everything is a great idea until we actually have to do it. And they've shown this in a number of experiments as well, where people were asked to choose between fruit and chocolate next week after dinner, where of course most people choose fruit because that's the right decision. But the minute it actually comes to next week after dinner, of course the preference reversal takes place and people choose chocolate. And so we get to the last question. And this one I just threw in to really drive home the point about critical thinking and the fact that the brain is very, very happy to make a very quick conclusion and move on with life not pay too much attention or use too much mental resources or capacity to solve problems it doesn't think it needs to. Just before we begin, this is or was not an IQ test. So there have actually been studies done. There was no correlation between people who got this question right or wrong and their IQ levels. So don't feel too bad if you did get it wrong. All right. So what we did was we asked if Jack is looking at Anne, but Anne is looking at George. Jack is married, but George is not. Is a married person looking at an unmarried person? So we see here that 75% of you chose no, or that it was impossible to tell, both of which are incorrect. Because if we pause for a few seconds, we realize very quickly that in either case, we don't need to know Anne's marital status because the condition is fulfilled. So if Anne, for example, is married, then the condition is fulfilled because she's married and she's looking at George, and George, of course, is unmarried. So if Anne is unmarried, for example, then the condition is fulfilled because Jack is married and looking at Anne, who's unmarried. So in both cases, the condition is fulfilled. If we spent a few seconds, we'd kind of realize this, but again, the brain's happy to take the shortcut. Some very interesting results from the survey, and I hope you've learned a little bit about belief systems and how sometimes we come to the incorrect conclusions very quickly.
What is the one thing we should be keeping in mind for the next investment discussion we have with our clients?
Andile, that's probably the $1 million question, and luckily the $1 million question is not that difficult to answer. So the golden rule is definitely that if your client's investment goals haven't changed, the plan to reaching those investment goals shouldn't be changing either. And this comes from some personal experience I've had in dealing with clients. People have very short memories and will have completely forgotten how they were feeling during this time of uncertainty in a year or two, when all they're left with is evaluating the currency depreciation or appreciation, depending on which way you look at it. And of course, some assets that they may have been exposed to in developed markets that haven't yielded very much. And that's really going to be a tough discussion. The second thing is, maybe something I'd just like to add on to that, is that the behavior tax is at its highest during times of market uncertainty. Now, a behavior tax is just the difference between what an investor would have gotten if they'd stuck to their guns or stuck to the plan, and what they actually got from their switching activity, which could be from greed, in other words, chasing past performance of something that they think could have given them a better return, or in fear of losing money. Now, Momentum Investments analyzed the behavior of 18,000 people over a period of 10 years, from 2008 to 2018, and we found that the behavior tax is the biggest during times of market uncertainty. And the reason is simple. When markets provide a shock, investors move to safe assets and they get stuck there. They really need markets to give a lot for them to actually gain confidence, or enough confidence to go back into markets and actually end up being in the wrong place at the right time. So I think today we've been discussing cognitive distortions. The biggest cognitive distortion out there or trap for investors is the market turbulence trap. When we look at our long-term investment goals through a short-term lens, we get this illusion of a lot more volatility or uncertainty. So I hope that from today's session, it's been clear that Momentum Investments are bringing different dimensions to the advice process here to help give better advice to clients. And a theme of today has definitely been critical thinking. And I'd like to end off with an example from David Robert Grimes, where he discusses in a book called The Irrational Ape how critical thinking actually saved the world. And I'll take you back very briefly to a cold September morning in Moscow in 1983, when Stanislav Petrov was watching his computer screen and must have got the shock of his life when the alarm sounded and everything went red. And what he noticed on his screen was 5 nuclear warheads heading towards Russia. Of course, it was his duty to report to Moscow that the nuclear war had begun, ending the Cold War. He decided not to do this, however, and to report instead that the system was faulty. And of course, the reason he gave was that why would the United States actually launch only 5 nuclear warheads? Why wouldn't they launch their full arsenal? So I think it's a really fascinating example of putting critical thinking before sort of the instinctive response, and how this can make such a big difference. And I think this, the message here for your clients as well, is exactly the same. In times like now, you can add a tremendous amount of value by getting your clients to think critically and thinking critically yourself, And I hope that Momentum Investments have positioned themselves as thought leaders in terms of the way we're helping provide advice to clients. I'd like to thank you very much for your time today. It's been an absolute pleasure being with you, and stay safe, and please, for your clients and yourselves, stay invested.
Thank you very much, Paul. Always interesting to hear what the technical marketing side of things is. I would, at this stage, before I introduce Dani van der Berg, who's going to sort of close the day up for us, I would like to take a moment to thank everybody for joining us. I hope that the information that you've picked up today has been valuable, information that you can take with you, the nuggets that you can use to have the conversations with your clients, and to equip you and arm you with the right information to take out to the market. All right. And then let me welcome to the screen Dani van der Berg, the CEO of Momentum Financial Plan.
Wow, what an incredible session again from Momentum Investments. We really appreciate your amazing support, but more so the incredible intellectual capital we have in investments as a team. But before I close, I've been asked to share with you that Momentum Collective Investments has a dedicated individual who will summarize today's presentations and discussions for you that would enable you to have this conversation with your clients. Her name is Emily Mahoku, and she's a fund specialist in the Momentum Collective Investment team. And remember, she's dedicated to MFP. And her contact details will most probably appear on the screen. And I encourage you to engage with her regarding any fund queries you might have. And in closing, I want to again congratulate you and thank you for the amazing support from an investment perspective. And we've seen it last month again, where you achieved 107% of target. But we realize how difficult it is emotionally to deal with the losses in terms of investments and also the uncertainty that surrounds us. Personally as well, I actually were confronted with the emotions in terms of what should I do with my investments. And then I've just realized the important role of actually having the facts and your important role. So yes, everything that was presented to you today, you should use so that you can contextualize the house view in terms of that you have to stay invested. It is so important. And yes, outcome matters. And therefore, we have the outcome-based funds available to you. And it's actually become even more relevant and important through these turbulent times. Yes, the bottom line is we stay invested, and I want to wish you well. And if you need any further help, please don't hesitate to ask us for whatever support you need to make sure that you are the professionals you are. Thank you very much, and have a strong following couple of months, because it might even become more difficult, and we will carry you through that period with facts and support. Thank you very much.